welcome you all on behalf of IAIP to this wonderful event. Once again, I'd like to welcome Basant ji. He has been a friend, philosopher, mentor, guide for IAIP. He has been associated with us in various initiatives, especially the CFA Institute Research Challenge, and where he has really, I think he really likes to give away. He is a great example of joy of giving. He likes to share his wealth of information and also tips how to get wealthy. So, and today I'm sure all of us will benefit from some of his expertise. So this is the first book reading event we are ever having for IIP, and I'm glad we are starting with Basantji once again on this. So before we start, I think I was the first few probably to get this book, okay, and I must confess that I have read not maybe 1/4 of the book as yet. I'll tell you why also. How many of you guys are familiar with the concept of Michelin star restaurants? Michelin. So when you go to Michelin star restaurant, you just go, don't go and gobble up the food over there, right? You go and savor each and every chunk of piece, morsel of food which you eat. So this book is like that. You have to enjoy each and every paragraph of it, let it sink into you, and appreciate it fully before you just finish it off. So I think that's a parallel to the restaurant, and I think each paragraph of a book is like a gift to the reader. It's just so much information. Just think over it. It's an easy read. No doubt, it's a very easy read. Unlike very complex books which are there on the finance. But the idea, I think, the intent of the book is to empower every reader to how he can have financial freedom to stock market investing. So once again, thank you, sir. Thank you so much for writing this wonderful book for all of us. So the way we'll do the format is, I have highlighted a couple of sections of this book, and I'll ask a couple of questions. If you have some questions on the text which I'm reading out, please feel free to ask him, and probably
sure.
Answer that. Okay. Before I start, that's the first quote of this book. किसको ज़्यादा कमाना है, किसको जल्दी कमाना है? ज़्यादा किसको चाहिए? Lift your hands. ज़्यादा and जल्दी? दोनों ज़्यादा and जल्दी? No. दोनों. So I think this is a very apt quote, which is there on the first author's note. Most investors can't figure out कि पैसा जल्दी बनाना है या ज़्यादा. I think this is a very simple. It's a very seemingly very simple quote, but I think all of us are always in a state of mind. Okay, we have to make quick money. Stock market is a way to get rich very quick. Okay, sorry. So maybe Basant, if you can share some thoughts on this striking sentence.
The question is, some quotes look very good when you read them, and you for a moment you just sit back and you say, oh wow, kya likha hai? But after a while, if your friend calls you up and tells you what are you looking at, and you tell him the old idea which you had bought 3 years back, he said kuch naya batao, and at that moment you also feel that maybe there is something for you to do more. Like now there's an election around the corner, and most people would be looking at certain stocks which they need to buy only for the election. So then you realize that there's a big question of how money can be made. If you've read through the book in chapter 2, you will see that I have elaborated on 3 points. What's the initial capital, the CAGR, and the N, the number of years. So most of us, jaldi is the rate of return. आपने 1 रुपया 10 सेकंड में बना लिया इस जल्दी, या आपने 1 लाख रुपया 1 महीने में बनाया इस ज़्यादा. But the point is the rate of change is immaterial. What matters is where you go finally. So jaldi and zyada is more of, you open up your television box, and very appropriately we call it the idiot box sometimes. So they'll always tell you buy this today, it's going to go up 10% tomorrow, and then you sell it out. So wealth is not made by buying stocks that move up 10% or 15% or 20%, because you were not poorer by 10, 15, 20% for you to have said, okay, this is done, now I'm free with my life. If 10, 15, 20% was the only thing that was holding you back from reaching financial independence, then stock market is not the way to be there. Go and put your money in a bank FD. Wealth will be made only if you grow it 10, 15, 20, 30, 40, 50 times. For that, you have to leave the jaldi part and focus on the zada. Because when you focus on the zada, you don't tend to lose money. But when you focus on the jaldi, the chances of going back to square one is also very high.
Moving ahead, and I think this book is replete with such kind of witty quotes and such in-depth statements full of that. Now moving ahead in chapter 1, I think this is a strong behavioral aspect I think which plagues every investor, including myself. Though I have been in the stock market for quite some time, but I have not been able to overcome this problem. Okay, here you have mentioned an investor has to be lazy in taking profits and agile in cutting losses. Thereafter you have, in the following paragraph you have mentioned, buying more of a stock after it has moved up from an investor's initial purchase price is a lot tougher than selling it to lock the gains. So basically what I'm trying to say is that once the stock, people are in a hurry to book profits, and this is a common problem, I guess.
Yeah, that's the point is, if you read that statement, investor has to be lazy in taking profits and agile in cutting losses, you'll say, oh, this is what traders do. Why should an investor do like that? It's for a trader who says let the profits run and you have to cut the losses. But if you were an investor and if you want your stock or your investment corpus to grow 10, 15, 20, 30, 40, 50 times over a period of time, and if you have a habit of selling only if the stock goes up 20%, then how can you see a stock go up 40 times? Another question which one has to think about is, if a stock goes up 20% and you have to sell it every time, then you would need a new stock, because if you keep selling a stock and it goes up 20%, then you've got to substitute that with a new one. So the point is that you have to be agile in taking cutting losses and very lazy in taking profits, because a stock that you bought, let's say a stock which I have personally bought and I've recommended this several ways, and also in the book I've elaborated on it. It's called Page Industries. They manufacture the Jockey brand of underwears and things like that. My first purchase was 350 and the last purchase is at 5,600. So you can say, why did you buy it 5,600? You could have bought everything at 350. The point is, I cannot buy today's stock at yesterday's price. If the stock has gone up and I get the money today, then I have to go and buy it today. I cannot buy it at the price it was trading at 4 years back. And many times, it is better to buy a stock that has gone up on improved earnings rather than to buy them after they drop in a string of bad earnings. So the easiest thing in the market is the most toughest to do. So if the company is doing well and the price has gone up, you don't go out and buy. But if the company is doing well and the price has gone up and it is supposed to do well, the earnings are supposed to be doing equally good, then you keep buying with every increase in price, because the money that comes to you will obviously come at intervals, as most of us are salaried or have fixed income profiles. But the point is, when a stock does well, the price goes up, the earnings also increase, then the investor also feels confident about that company. It's very difficult to feel confident about a company in the very first initial stages of growth. So when the company has demonstrated its ability to grow for 2 years, 3 years, 4 years, then you're sure that what the management is saying, they will do it. The management also gets tested by its past predictions. You can also qualify yourself by saying, okay, the management told us that they're going to do this and they've done that. So I think it's better to buy a stock once it goes up, rather than to buy it everything in one go and then sit on a pot of problems the moment anything goes haywire.
Just to follow up, I think when you started your investing career, did you face such kind of challenges? Okay, I have made some, because I think in your book you have mentioned that how you started from nothing, right? Everything, some problems, Kashmir, etc. Were you tempted to take profits, book profits, take everything on the table early? How did you overcome that?
I'll tell you, it was my initial visionary thought, a borrowed one of course, was that whatever happens globally happens in India. जो कुछ बाहर होएगा इंडिया में होएगा after a lag of 10, 15, 20 years. So if you had organized retailing doing well in US in the 70s and 80s, it will do well in India after 20 years. If you had Fannie Mae, Freddie Mac doing well in US in the 80s and 90s, you had HDFC doing well. If you had a Wells Fargo doing well there, you will have a HDFC Bank doing well here. So that combination of applying global business models into Indian context and then thinking whether they can work or not was the initial driving force that got me into thinking that you can do real big things with the stock market. And luckily, I wouldn't say unluckily, because we made money out of that, I bought Pantaloon Retail. Possibly had I known so much about investing, I could have skipped Pantaloon at that time, because it was a negative cash flow company, diluting equity, raising debt, holding an inventory which wasn't valued in terms of how it should be valued and things like that. But when I bought Pantaloon retail, the idea was Walmart has done so well there, so maybe Pantaloon can do well here. Of course, now the question was, can they survive 10 years? But who needs 10 years if you can make 40x in 5 years? So the stock market is very different from running a business. Because when you run a business, you have to go out and show profits and then pay taxes and then you can distribute them as dividends. But if it is a stock market, everything gets discounted today. So if Narendra Modi is voted to power, as the entire investing community thinks they should be, so the companies might take 2 years to report earnings, but everything will happen today. So to that extent, my initial thoughts were that if I bought Pantaloon retail, I should not sell it very cheap. So, but when the stock doubled and then doubled again, so obviously there was a lot of stress to sell it. But then the only thing was I kept looking at Walmart, kept seeing their price history. Of course, it was a wrong comparison because Walmart had a very different model. They started from one region in US and they started expanding very slowly. But Pantaloon was all over the place. One store in Chennai, the other one in Kanpur, and the third one in Bombay, and the fourth one somewhere else. So, but stroke of luck, tailwinds, and a sector which is in demand. A sector which is in demand always does well. Whether the company does well or not, the investors will do well for a period till the time the sector is in demand.